Welcome to the Financial Feast podcast. Today on episode number 12, we are going to be discussing how to invest in the stock market.
Yeah, actually, one of the biggest questions that people have is how do I invest in the stock market? And do I invest on my own or with a financial professional? So today we're going to show you how you can invest on your own or with a professional, some options, pros and cons of each, and which you should consider.
Yeah. So I think most people, when you think investing in the stock market, especially for new investors, you think financial professional.
Yeah.
And you probably don't think or even consider investing on your own.
Yeah, I think intimidation, right?
And
you don't know.
It kind of makes sense,
Yeah.
right? Because
Yeah.
that is a little, right? We're putting our money into this organization of the stock market that I don't fully understand, and I don't really know how to manage it, and I don't understand the risks and how to kind of work through all these things. So I'm just going to pay somebody to take care of my money. And that's a fine option.
Yeah.
We have nothing wrong with that option.
No.
But what we wanted to talk about today is why maybe people should consider investing on their own.
Yeah, absolutely.
And with a professional.
Yeah,
But
sure.
investing on your own is a good option.
Yeah, and it is an option, right? And just this is to enable you to be a little more comfortable on doing it yourself. That's the goal of today. So opening a brokerage account and buying investments is your first option. But what is that?
Yeah. So when you're looking at, all right, so how do I invest on my own? And somebody says, well, open a brokerage account. We're like, what is that?
Yeah.
I don't understand
fancy.
what a brokerage account is, but it's pretty simple, actually. Brokerage account isn't a complicated, complex thing. It's simply just an investment account that you can buy through, or you can open through a number of different things. You can open it through a professional. You can go to a financial professional and open a brokerage account, or you can do something online like E-Trade or Wealthfront, Betterment Online. Everybody's heard of Robinhood.
Yes.
That's a brokerage account. Everybody knows that. You can also open it on your own through different brokerage dealers. We have Edward Jones, Merrill Lynch, TD Ameritrade. And then there's investment companies like Vanguard, which we really like. So there's a lot of different options that you can just go. And all you're doing is you're just opening up a fund that now gives you access to different investment options.
Yeah, and we'll go into a little bit more detail about what that looks like here, but really that is the crux of the matter is when you go open up a brokerage account, it can be done either with an organization or by yourself, just through an online trading platform like E-Trade, as we had just said, Robinhood. But now that after you say you've opened up an account, you decided, okay, I'm going to do this by myself, right?
And let's just pick one.
Yeah, let's just say E-Trade.
Yeah, okay.
So you go onto E-Trade, you open an account. Now what? How do we fund that?
Yeah, so funding the account, pretty simple, right? You have money in your bank account, checking account, savings account, whichever one you want to do. All you're going to do is transfer money over into the brokerage account.
Yeah, and you can even do recurring ones.
Yeah. You can set up monthly or weekly or whatever you want to do. You don't have to just do a one time. That's right.
Yeah, and the other question that some people might have is, I don't know what a good amount of money is to put in. Like, how do I start? What is the amount of money I should be putting into it?
Yeah, so when you're working with a financial client of yours and they have that question, there's not usually a one-size-fits-all answer, right? So how would you help them figure out what a good number for them is?
Typically, I like to get them to 10% as much as possible, but you can't always start at 10%. So start where you can start is what I always say.
So when you say 10% of what?
Their gross income. Yes. 10% of their gross income I'd like to be investing. So with that, when you look at all of the numbers that go into that, at least 10% is where I'd like to hit. 15 would be better, but 10 is a good spot.
Now, are we talking about investing all of this money? If they're not comfortable with that, we're okay with them doing $400.
Yes.
Right?
Yes.
$200.
Something
$50,
is better than nothing, right? Yeah.
Because just getting started and understanding, hey, this isn't as complicated as I thought. I can actually kind of do this, and getting comfortable with the idea of investing is important.
Yes. So important. And when you think about it all, a lot of the things that you have to really think through it is, when you're thinking about how much money you should put in, don't overthink it.
Yeah.
Start with $50.
Yeah,
and then do recurring.
Do what's comfortable.
Right.
Right?
Right.
If you're, it might make mathematical sense. And looking at your bank account, you might be able to comfortably do $4,000, but you're just not comfortable with it. It's just difficult with you. Don't pressure yourself and make yourself uncomfortable. Do a little bit amount just so you're doing something and so you can get used to it.
Absolutely. So there's different investments that you can invest in when you open up an E-Trade account. So you might be thinking, okay, I have my account, I have money in it, I don't know what to do now.
Yeah. So when you're looking at a brokerage account, like we said, all that is it's an opportunity to buy different investment funds or different investment options. Because I could put my money into a bank, into a checking account, into a high yield savings account, into a regular savings account, a money market, whatever I want to do. But I don't have access to buy investments that are going to be growing me money in my checking account. My money's just sitting there. Whereas a brokerage account, what you're doing is you can buy these different investment options, which we're going to talk about quickly here, that will allow your money to grow, which when you talk about the stock market, a lot of people are saying, well, I got a blank return, I got a 6% return, or I got a 10% return. The reason they're doing that is because they're buying these different investment options, and these investment options come with an inherent risk of potentially losing your money, but with that risk comes an opportunity for growth. Whereas in a savings account or a checking account, you don't have those risks, but you also don't have those growths.
No, you don't.
So do you want to run through quick just a couple of different options of investments that people can look at?
Yeah, so there's individual stocks. So these are just individual companies like Amazon, Apple, Google, these big companies like that, little companies. Individual stocks typically are more risky because you're putting all your money into one entity.
Yeah.
So diversification, which just means spreading your money out into different ones, is key there. Bonds, typically a safer investment.
Okay.
It's one of those investments that doesn't have that high of a yield compared to a stock, possibly, or an exchange-traded fund.
An ETF.
Yep, that's an ETF, and that's a popular one, the ETFs, exchange-traded funds. Mutual funds and an index fund. So a mutual fund is just a grouping of individual companies all in one, and it can be just about anything. There's so many out there. If you're interested in doing mutual funds, I would recommend going on Morningstar. It's a good website that rates them, and a good 5-star mutual fund. There's a lot to dig into there. We won't dig into it that deep. We're just kind of telling what's out there on this one. But an index fund as well, that just measures the index of maybe the S&P 500, or there's many others that we talked about in previous podcasts. You can invest in the whole index, and that way you're diversified. And as you have more risk reward, but there's less risk in that one.
Okay.
Same with a mutual fund, less risk because you have a big grouping, and you can group it however you want, whether it's tech or manufacturing or conglomeration or large companies, small companies. There's so many out there. There's also REITs, which is a real estate investment trust. It's kind of a grouping of real estate properties that you can invest in that give you a percentage back on the earnings. So you can't buy a rental property maybe you don't have enough money to just do that. So you can go into these REITs that give you a little bit of that taste of that, and you can get some money for it. And then there's the target date fund, which I might recommend to start there.
Yeah, target date funds are a great place to begin because they take a lot of the headache out of trying to figure out we'll talk a little bit later in a future episode about kind of balancing your portfolio and dealing with risks and how to manage all these things as you're kind of growing closer to your retirement date. But what a target date fund does is it kind of does all that work for you. So for people who want to invest on your own but are nervous about trying to figure out and pick a great option and kind of stick to that one option because you don't really feel comfortable enough to make those decisions yourself without a financial professional, a target date fund kind of does a lot of that work for you. And what you do is you pick a date that you want to retire, and you start putting your money in, and then it manages your money and kind of changes things up as you're getting closer to that date. So, and there's a lot of different ones that are available. When we're talking about these different investment options, these are found everywhere. So if you go open up a brokerage account with a professional and you have a fee that they're going to charge you, you have an option you have availability to all these different investment accounts or these investment options. But if you open up a brokerage account on your own, right, through an online thing like E-Trade or through a company like Fidelity or Vanguard, you also have options, right?
Yeah.
You have access to all of these different options. So the difference we're talking about here with a brokerage account is either you're going to have a fee if you have a financial advisor, or you're not going to have a fee. I mean, you're still going to have a fee with some of these, but they're going to be small. But you're not going to have that financial advisor fee. But this brokerage account just now gives me options and gives me access to all these different investment options.
Yeah, it's kind of like your key, right? You're unlocking a door there for retirement yourself, which is really nice.
Yeah.
And one thing to just be aware of is capital gains. So a capital gain is when you sell and make money on a stock or a fund. So just to make things simple, say you bought a stock for $1 and you sold it at $2. Mm-hmm. Now you have $1 of capital earnings right there where you would be taxed on that dollar of earnings. And typically it's in your tax bracket around 15%, depending on where your income tax bracket is.
Okay.
But just be aware that when you're doing, if you ever do something like day trading or something more advanced like that, like those people that are selling and making that money, they're still having to pay taxes on those earnings.
On all that stuff that they're selling.
Yes, and actually the government really tries to incentivize people to hold it for more than a year because they're generally lower in the capital gains tax when you hold it for longer than a year. So under a year, capital gains tax is higher because it's whatever tax bracket you're in. Long term, it can be around 15%, but it could be less as well.
So this was the first option. So we're talking about self-investing. This was the first option of self-investing. Simply what you're going to do is you're just going to open a brokerage account, and then you're going to fund that. You're going to choose which options you want to put your money into with all these different ones that we talked about. And then you're just going to do it on a regular, semi-regular, whatever consistent basis you want to do. And ideally, you want to hold it for a long period of time, not only just to avoid the capital gains taxes, to minimize those, but also to really capitalize on the fact that you're going to be compounding the growth on all these different things the longer you hold them. So that's option number one. Option number two for self-investing is you can also open up an IRA or a Roth IRA, and we like them both.
Yep.
They're both great options. We really encourage people to open up a Roth IRA, and we're okay with you opening up an IRA, a traditional IRA. You can actually have both of them.
Yeah.
You can have both of them at the same time. But we really enjoy the benefits and the rewards that a Roth IRA gives you. So the second option that we consider to be important for self-investors is to open up a Roth IRA. And when we talk about how can I open up a Roth IRA, it's if one of your clients, Kevin, comes up to you and says, look, I have a brokerage account. I'm already investing a little bit of money every single month. I have $100 going into that every single month. I'm just trying to get comfortable with investing. I'm trying to get comfortable understanding what this looks like for me, get comfortable with the risks, understand a little bit. But I also have heard the benefits of a Roth IRA, and I want to do that too.
Yeah.
How do I do that?
Yeah, so there's a couple ways to do it, but if you decide you want to do it yourself, I would recommend going to a trusted platform like E-Trade, Fidelity, Schwab, Vanguard, any of those. Mm-hmm. And it's free to open one, which is awesome. There's a minimum to how much you can do a year in a Roth IRA or in these IRAs. It's, I believe, $6,500.
Well, that's the maximum.
Or
maximum you
sorry.
can do, yeah.
Maximum is $6,500.
And it depends on, there's a lot of things that go into that depending on your gross annual income.
Right.
Some people can't do it. But for the majority of people.
For the majority of people, the average American, $6,500 per year max. The other thing to think about is there's a couple other ways to do it. You could do a robo-advisor on it. Mm-hmm. So that's through like a company like Acorns or Wealthfront. Some of these have minimums that you have to have, like $500 minimums, and then they charge a little management fee. But typically for a robo-advisor, it's a lot cheaper than a financial advisor. Mm-hmm. But once again, that's something that someone else is managing for you versus you doing it on your own. So if that's something that you feel like you need, that's great. That's an option. If you feel like you want to do it yourself still, go just to the website, open up a Roth IRA, and start putting in money.
Yeah, so you can go directly to Vanguard.com, right? And they're going to have an option on the page that is open up a Roth IRA. And it's essentially just like opening a brokerage account. You're gonna choose, I want to open this. You're gonna fund the account with money from your bank account. You're gonna choose what options you want to put money into. They may have some. Vanguard especially does a great job of recommending mutual funds.
Yes,
they have a really good target date funds. And then these other options. Fidelity's a great one. Schwab's a great one. They have low fees. They make it very easy and accessible. So they're very good options. But it's really simple. It's not complicated,
no.
Right? And I think people, because they don't understand how to do this, or they don't understand all the in and outs of it, they're afraid to kind of take that step. And rightfully so, right? Because this is the money that you've worked hard at your job to get. And I don't want to just put it out there and lose it. Yeah. Right?
Yeah, and just we've talked about it before, but in case you haven't seen it, a Roth IRA is something where you pay taxes up front.
Yes.
Right? So you pay it up front so that when you withdraw it, you don't have to pay any of those taxes that you already paid into it.
Right.
Whereas a traditional IRA, you put a bunch of money into it and then you pay taxes when you withdraw it. So that's why we recommend the Roth, because especially if you're younger, you're able to pay the taxes now, because historically taxes only go up.
They're going to keep going higher.
Yes, yes. And it's good to just be able to withdraw that and then know that you have all that money right there.
Yeah, and that's why we like the Roth, because all that money that's growing over the next, if you start it when you're 20, all that money that's growing over the next 35, 40 years is all growing tax-free.
Yes.
All that money that I'm going to have in 40 years off of that growth, I don't have to pay taxes on it when taxes are going to be higher in 40 years.
Right, versus withdrawing a traditional and 33% of what you saved is just gone.
Yeah.
You know, and it could be higher or lower, but about that amount.
Yeah.
So there's different strategies out there for investing. There's so many, actually, but we're going to cover the main: day trading and buy and hold. Those are the two biggest ones. For retirement, day trading is not what you want to do.
No.
No, that's the quick stuff. That's when you have your brokerage account and maybe you're doing some fun money stuff. But there's so much you need to know to do day trading. As far as you need to pay taxes on your earnings. It is risky. It's more speculative than it is anything else. No one can ever predict the market. That is a fact.
Yeah.
Maybe you can know a few things that other people might not know as much of, but that doesn't necessarily translate into those earnings all the time. Mm-hmm. But buy and hold is what our strategy that we would recommend for retirement.
And this is for both investing on your own and investing with a professional.
Yes.
We want you to hold the money for a long period of time, because that mitigates risk because there's trends over a long period of time that you're going to be avoiding these ducks and these dips, ducks, dips, I don't know what, these downs, all D's, I'm going all D words. These downs in the market, you're going to be kind of avoiding them, not avoiding them, you're going to hit them, but you're going to be mitigating their effect on you, because you're also going to get these big swings up and they're going to kind of even out. Whereas if you're trying to day trade and you're trying to time the market and be, I'm going to be smarter than everybody else, you're probably going to hit it when it's low and stick yourself. So, but the problem is when people think I'm investing on my own, they think day trading. Most of the time, I'm going to handle my money on my own. I'm going to buy a stock, an individual stock, and I'm going to sell that stock when it goes up 10%, and then I'm going to use that money. I'm going to buy something else at a low cost, and then when that goes up 10%, I'm going to sell that. I'm just going to keep making more money, right?
Yeah.
And that's not the case for most people.
Right.
So we're all about that buy and hold.
Yes.
So
that's the key in retirement. The more you buy and hold, the more that you're likely you are to do well.
Yeah.
And a key point, we talked a little bit about diversification, but once again, making sure that you don't just put all of it in Apple or one single stock. Sure, Apple might be a great company, but if something ever happens to it, you want to make sure that you have your checks and balances set.
Yeah.
So that's why a good fund is good, because that automatically does diversify for you. And it's a fancy word that just means put your money into multiple baskets.
Yeah.
Right? You don't want all your money in one basket. So there's domestic stocks and international, but we'll talk more about that in another episode. But just understand that you can do it yourself. Opening an IRA is easy. Know what you're doing with the target funds. Pick your target funds, start there, and then branch out from there.
Yeah.
And know that you can do it.
Yeah. Yeah. So that's option kind of situation one, right? Investing on my own, and you can do it through a couple different ways, but essentially you're going to open a brokerage account, you're going to fund it, you're going to choose what investment options you want, and you're just going to hold it forever. No day trading. We're going to hold it, and we're just going to keep allowing it to grow over time. Option number two now is, and option number two is not fighting with option number one.
No.
You can do option number two in addition to option number one.
Yes.
Option number two is having a professional that's helping you manage your money. And we're going to talk about two different ways you can do this. Either you can do this through a work account, or you can do it outside of work account, and you can hire a person or a company to help you manage your money. So when we're talking about when we're talking about investing in a work account, most people are probably going to think of a 401k.
Oh, yeah.
Right?
For sure.
We also have a 403b, but that's what
Yeah.
we're talking about when we're talking about a work account is a 401k, 403b, investing in that. And when somebody wants to invest with it, and we're including this in the professional, the financial professional, because your 401k is managed by a company.
Yes.
It's not managed by you.
No.
I'm not making the decisions. I'm
Right.
putting my money into an account that's managed by Wells Fargo or whoever's doing it.
Yes. And there are sometimes options you can pick in a 401k, but they're usually pretty limited.
Yeah.
So what a good financial advisor will do, though, is they'll take your whole financial picture, right? And they will take into account your 401k, your 403b, and in addition to that, do maybe a Roth IRA or traditional, depending on your situation. Making sure that you're set for retirement is key. Putting all your money in a 401k is great, or is an option, but it's not the greatest option because once again, you have all your money in one spot.
Yeah.
But it is a great investment and savings vehicle for retirement because a lot of it is out of sight, out of mind.
Yeah.
When you get your paycheck, it's already been taken
You're
out.
just automatically giving it away. And I
Right.
don't even know that I have that money because it's to be taken out before I even see it a lot of
Yes.
times. So
Yeah.
it's nice.
It is. And another option that a lot of people might not be aware of is the Roth 401k is getting a lot more popular.
Yeah.
So seeing if you have that option available and doing that is really great because then it has that same effect of the Roth IRA where it's tax-free when you withdraw it versus losing a lot of that to taxes. when
Yeah,
you do
because
withdraw.
the 401k, the money that's just growing, I haven't paid taxes on it yet because it's coming out of my paycheck before I pay taxes. So as it's growing, when I withdraw it at 65, when I retire, I now have to pay taxes on it at whatever tax bracket I'm in.
Yeah.
Whereas a 401k that's a Roth, it's growing the exact same way that a Roth IRA is, where the money that I'm growing, I've already paid taxes on it. The difference between these two and why a lot of people do a 401k is because you have more money that's growing typically because I'm putting more into it because I haven't paid taxes on it. So if I have $1,000 and I get taxes off of that, I now have $800 that I have accessible that now I can invest, right? If I put the money in before I get taxes on, I have $1,000 that I have available. So you can grow more money in a 401k because you're not paying taxes on it, but you're going to pay taxes on it later. So you have to kind of weigh, what do I think my tax bracket is when I retire? What other options do I have? What's my tax bracket now?
Yes.
All those different things come into play. And that's where a financial professional can really help you walk through that, where a lot of people on their own might be like,
yeah, they might
I don't know.
They don't know. They might be uncomfortable. They might not know. But the number one thing I always say is find out what your company matches and at least get that.
Yeah.
Because that's free money. They're putting in a percentage of money. Typically it's 6-3, right? Around that, depending on your company, how they work. But getting a free money in your 401k is something that you just have to do.
Yeah. And then I forget the exact stats. I've looked it up so many times, but I forget what it is. I think it's like 86% of companies offer a retirement account, and most of them offer a company match.
Yeah.
So for people, you might not even know your company has you might know they have a retirement account, but you might not know they have a company match. So going to your HR and talking to them about, hey, do we have one? Oh, we do. That's awesome. How do I get invested in this? How can I start investing that money? And do we have a company match? Oh, we do. You're going to give me free money for me putting money into my retirement. Sure, let's get on that train.
Right.
Let me start getting more money on my account for not doing anything because you just want to give me money. Yeah, great option. So talk to your HR, talk to whoever. Maybe you don't have an HR because you're a smaller company, but talk to somebody in your company and figure out if this is an option for you because it's a big deal. So